Okay, good afternoon everyone, and welcome to the Polaris Trading Group's PTG University Educational Workshop Series. Today's Wednesday, October 1st, 2014, and today's topic is going to be understanding the ATR stop line, the average true range stop line. Okay. Alright, so on the average true range stop line, I've outlined some topics here that I want to address. The average true range, the ATR, what the actual definition is of average true range, its calculation and construction, breakpoints as we speak about, so you get a better understanding of when we talk about breakpoints, its meaning, the implications of breakpoints, the proprietary filter, right, which I've created to reduce what are called false positives, and practical usage in making trading decisions. We all want to know the usage of it. And then as we get into the usage of it, the blending of the ATR structure with core trade setups such as stackers and premium and discounts, and simply we'll be putting that all together. All right. So let me just move over to what the construction is of it and the definition. Okay, so what I've done is I've pulled in the definitions of average true range, and this is taken from stockcharts.com. Okay, and if you'd like, I'll copy that over to you guys in the chat, and then that way you can zoom into that website. But simply, it's this is a volatility measure. It was created by Wells Wilder, and he's quite a very good technician, mathematician, and it's simply what the average true range is. It takes the current high less the current low. There's one method. There's a variety of methods here. The highest high and the highest low of a period. And so, for instance, inside days, okay, are not necessarily counted, but rather the range high and the range low of a number of days. And typically, the number of days that were originally calculated was 14. Okay, so, and generally speaking, using a day session chart, so if the day session, high, low, and it would continuously calculate the highest high and the lowest low, okay, throughout a rotating period of about 14 sessions, or 14 bars. Okay. Okay, so let me just show you a snapshot here, and again, this is on the website, and you can kind of go over the calculation yourself for those of you that do the math. But you take in method 1, all right, you can take the current high less the current low, all right, from the previous close, and so forth. It's probably best that you, if you want to learn more about this, go right into this website, and this will educate you a little bit deeper than what I want to accomplish here today. What I really want to do is get involved in how we use the average true range and the construction of the stop line that we use for our trading purposes. So you can all kind of, there's a lot of information on this particular website, so go into that calculation there if you want to learn more detail about it. All right, there's actually a formula in there that calculates it. All right, so let me just move this chart over, and we'll get right back into our chart. So the calculation construction, the definition, we want to go, let's go right, just simply right to the charts. A picture kind of is worth 1,000 words here. All right, and just kind of pick a location here. So what effectively it is, all right, if you go into the studies and you go into average true range, okay, and you just highlight that, put it into the settings here. And again, all the platforms that you have are based upon average true range. So we use a 10 period average true range. Okay, so simply what that will show in the lower window, okay, it will show the, at any point along the price chart, okay, it will show the average true range, okay, of the current, where those current bars are. So for instance, right at this peak here, all right, 1.17, so basically 1.25 points is the 10 period average true range. So simply over the past 10 bars, all right, the average range, the average true range of those has been 1.25. Okay, then as volatility increases, all right, usually with down moves they increase, the volatility tends to spike. You'll see over here the volatility spiked up to 1.5. Okay, so what this simply does is this is a constant calculation of the last 10 bars. All right, now the average true range on a, we're looking at a 750 tick here. The average true range on a 750 tick will be different than a larger time period or tick size. All right, simply because of the expanded range of each individual bar. Okay, so it is it's self-adjusting. Okay. The ATR line is, the ATR stop line, it's self-adjusting. All right, so that being, that's the basis of it. And what we take that value, okay, and let's go into the ATR itself, the settings. Okay, and in the settings you'll see the ATR length is 10 and the ATR factor is 4. Okay, so what we do simply is take the ATR, which was what we call it 1.25, all right, times 4, all right, and that gives us 5. All right, so the ATR line represents, all right, the average true range at any point in time times 5. So 5 times the average true range. So that's what we call the ATR factor. Okay, and then it's designed to be trailing below price if it's in a bullish formation, and above price if it's in a bearish formation. Okay. So that being said, the next point here on the list here would be breakpoints. Okay, and then we'll get into the proprietary filter. Okay, so what the breakpoints simply mean and show, all right, is that it's the point at which the bearish ATR line, all right, switches. So the yellow line here is the bearish ATR line, switches to a bullish ATR line. Okay, and then you'll see vice versa here. Okay, where the bullish ATR line switches over to a bearish ATR line. So these are going to be important developments in the price structure, and it's going to help signify and signal for us, all right, what the current condition in price is. In other words, how much energy there is in price. Okay, and is there enough energy to effectuate a what we are calling now is a point break? So at these points, at these intersections, these junctions between, it goes from bear to bull and bull to bear, those are going to be called break points. Now the next part of this I want to show you is the filter. All right, well, before I show you the filter, okay, take a look at this area right here. Okay, now, and this is important. Okay, same thing down here over on the bullish line. Most of the average true range stops lines that are out there on the forums and in trade packages, okay, most of them are third party. What happens here is there's a different ways of calculating when the ATR line should shift. Okay, so again, shifting from our point break standpoint. And in many average true range stop indicators that are out there in the public, what happens is as soon as price pops up above that line or below those lines, that ATR line, it effectuates a shift. Okay, and that may work perfectly well on time charts, 5-minute, 15, 60, a daily charts, because they're much more significant events if an ATR line is broken by a 5, 15, 60-minute type chart. It's not as significant. In other words, when we come down in tick size and we come down on the intraday basis, okay, breaking an ATR line like this right here may not be the proper event that we want, you know, in terms of the price action and price structure. So if it broke the ATR line on the upside here at these, you know, kind of these 2 points, what happens is it'll go from a bear ATR line to a bull ATR line. Okay, then it'll switch over again back to a bear, back to a bull. And what happens is, if you don't dampen that effect, in a sense, you get a lot of what we call false positive signals. Okay, and the whole idea about the ATR line and the way we specifically use it is simply we want to have the confidence to be able to use that ATR line as a trade opportunity. All right, we'll discuss trade opportunities from them. But more importantly, that we know when price pops up here to the ATR line, that all of a sudden it's not gonna shift. Okay, we want to know when in fact, you know, it has shifted. That we want to have the confidence, right, to go with that shift. So in other words, if the shift is from a bear ATR line to a bullish ATR line, well, I want to know that ATR line is solid support for me, and that becomes a dynamic support point. Okay, and as you can see here, and as we'll discuss further, this becomes a very important aspect of what we do. All right, if you're getting an ATR line that's constantly shifting back and forth, giving you a lot of false positives, you simply won't have the confidence in using that indicator. All right, and you'll just pretty much trash it and throw it out the window, because as soon as that bar touches the line, it shifts. But you can see at these points here where it either touches the line or exceeds it slightly. Well, the ATR line didn't shift. What happened after? Price sold down. What happened after here? Price sold down. Okay, so in those circles, those become a very good opportunity to actually take a short trade. Same thing down here on the low end. All right, on the bottom left-hand side here. Okay, the ATR line breached. The price breached the ATR line, but it didn't shift, so it actually provided a good opportunity for a long. Okay, so this is going to be important for us to work with. Okay, now what I want to do next is show you the filter, all right, that I've created. And believe it or not, it's not that difficult, you know. Okay, let me change the colors here, all right, so we can see them a little bit clearer. So after some experimentation, okay, you can see the setting here. It's a moving average exponential, okay, and again, a lot of what we use is our moving average exponential lines. But the idea here simply is, let me just zoom in a little bit further on some of these, is I've taken, okay, I've taken a 5-bar or 8-bar average. All right, let me see which ones I use on this one. Hold on just a second. Okay, this is a 5-bar high. So you can see the input data here is a 5-bar average high, and then the other moving average is the 5-bar average low. So what I simply have done is I've dampened the effect of the individual price bars. Okay, moving up, moving down, moving up, moving down, and I've taken a 5-bar average high and a 5-bar average exponential low. Okay, So what does that mean for us? How does this work? Okay, so let me just show you here. All right. To effectuate a bullish shift, which simply means going from the bear line to the bullish line, okay, the 5-bar exponential low has to breach the ATR line, and it does so right there. Let me put a bigger marker on here. It does so right here. Okay, everybody see that? Right in here. So that's the 5-bar average low. And the reason I'm using that 5-bar average low, all right, I can use an 8-bar or a 10-bar. I can kind of make it a sensitive, just by changing the number there to a 5, 8, or 10, or 14-bar low or high. I just changed the sensitivity a little bit. But I found that the using a 5-bar average low high works pretty well, and it gives us really good clean signals. And again, it's always a balancing act between what settings to use. But the idea here is very simple. I want to know if there's enough energy, okay, to move price through the high enough through that ATR line, okay. Yeah, I'm gonna have to check on that, Monty, because using a range chart. I'll check with you and I'll get back to you individually on that. Okay, I don't think it's going to be a whole lot different. I think we're still okay with the main settings, but I will double check with you on that. Okay, but the concept here is exactly the same whether you're using a range chart or whether you're using a tick chart. All right, for that matter, even a Renko chart. But I'm not a big fan of Renko charts. But simply the question we want to know is simple. I want to know that there's enough energy in price, okay, moving up through that 4 times the average true range. Is there enough energy in price to effectuate a shift? And if there is, so if the answer is true, if there's enough energy and it essentially effectuates a shift up through, okay, the ATR line, then I want to buy or look to buy that pullback to that ATR line. And now that new ATR line, okay, which is the white one, all right, becomes dynamic support. So a lot of you, have asked me about, well, if I buy a pullback here, and again, we'll discuss buying stackers and so forth along with this. But if I buy a pullback here, all right, into this zone, all right, well, where do I put my stop? Do I put my stop, way down at the lows here? All right, that's too much of a stop point. Well, the answer is no. Okay, and watch how the function of the 5-bar average low works and high. Right, the 5-bar average low in this case broke the ATR bear line. Okay, because there was enough energy. Now look at in order to break this white line, this bull line now, all right, the bullish ATR line, what's going to need to happen? Think about this for a moment. All right, there needs to be enough energy, downside energy, okay, not just in price, okay, but in the 5-bar average high of price. All right. What are you asking, Rob, about just below the ATR line? You mean putting a stop? Yeah, you can put a stop below the ATR line. Yeah, absolutely. You can put it below the ATR line. Okay, definitely yes. But think about this for a moment, and this is what one of the key components of today's discussion is I want to make sure that you understand the filter that's being used. Okay. And the understanding of it. So again, in order to break the line, the bear line to the upside, the 5-bar average low has to breach the line. Okay, then it changes and it shifts the dynamics in price. That's why we call this a point break. All right. Now, in order to shift this back down negatively, all right. So as price kind of pops down here, I want to be buying. All right. I want to be buying, in this zone here, where all those diamonds are, because if I buy on a pullback into the zone, then my stop will be somewhere below this ATR line. Well, again, in order to break this ATR line, shift it, the 5-bar average high is going to have to come down far enough in order to effectuate a shift. All right. So when you have a point break shift, as we see here, so from bearish to bullish, okay, this is a buying opportunity. Bar none, this is a very strong buying opportunity. Okay, let's take a look at where, and as the price accelerates, okay, you can see that the 5-bar average high, right, which is again, that's going to be the trigger for shifting the line, right? Price is rising above the 5-bar average high and the 5-bar average low. So it has its own little mini channel. Does everybody see the mini channel here in price and the 5-bar average price, 5-bar average high and low of price? All right, there's like a little mini channel. Okay, so you can actually, on your own computers that have, everybody that has the software, you could actually, I hide these lines, but if you want, you could actually, expose them, make sure to see them. But I currently have them hidden, simply because, we have other, moving averages and things that we use, and essentially these were designed just to effectuate a shift. But the idea is, if price is above the 5-bar average high and low, so that little mini channel, that is one heck of a bullish configuration in price. Okay, now think about it. The trailing line now, we can use it. So let's just say down here as an example. All right, we entered here, okay, somewhere on a bull stacker. Okay, and we got our ATR shift and we got our bull stacker. Now we have the confidence to say, the likelihood of price coming back down here, all right, and breaking this ATR line is for all intents and purposes, slim to none, and slim left town. Okay, and so we have a great amount of confidence to say I want to buy them here and I want to buy them aggressively. All right, and then the only way I'm going to really bail out of that position is if it comes back down and it breaks back down through that ATR line. Okay, so yes, there may be individual bars that kind of spike down through that ATR line occasionally, right, because of the given volatility, but it's going to take a heck of a lot more to break that line, because it's going to take an average of 5-bar highs to break it, not just 1 bar. Okay, so this hopefully will give us some greater confidence that when we get these point break shifts, I want to stay with that that configuration. Okay, and then look to buy pullbacks, look to buy that stacker, look to buy premium and discounts, as they develop. Okay, this little area right here, just say for instance, using a practical approach here, this little area right here, think about this for a moment. Okay, and this is important because one of the big questions I continually, have been posed is that, yes, we're looking for discounts and premiums, and those are very good in and of themselves, right? Today worked very, very well on the premium side. Bruce had a great day, saved his hide, he said, in many cases, and provided him to get in on an opportunity, today on the short side. Okay, but think about this for a moment. Most premium or discounts don't usually develop until a bit later in the move. Right? Everybody agree with that have been using premium and discounts? Okay. The bull bear stacker formation, okay, and of course the ATR line is a key component of that trade setup, and that's why we're speaking directly about the ATR line today, because I want you guys to understand not only the construction but the filter, all right, and hopefully we'll increase that confidence. But most of the question has been, geez, we came off of a low and I was not able to, how do we get in on the signal here? How do I know that this, shift is a valid shift? Okay, well, we're going to just scale through or scan through the chart here, momentarily, and I'm gonna just simply show you historically how all these ATR shifts, have really, if you look at them saying, wow, if I just took an ATR shift on a shallow pullback, all right, whatever pullback develops, if I just entered on that pullback following an ATR shift, positioning myself, remember, not really necessarily looking to get just 5 or 6 or 8 ticks, but really kind of positioning myself for a bigger move perhaps. All right, now does it always develop that way? Of course not, but we want to be positioned that if it does develop, all right, if we have multiple contracts, right, 2, 3, 4, I can sell 1 or 2 and finance the trade, and then use the ATR as a trailing stop, like Rob says, like entry with a trailing exit signal. Okay, so the entry would be on the bull stacker. Again, we're talking about the bull case here. It would be a bear stacker for a short. All right, and then as the price is again, you can see it moving up. Simply every time it makes new highs, you see it kind of ratchets a little bit. Right, this is every time it kind of stair steps here, stair steps a little bit there, stair steps here. Okay, stair steps there. All right, every time it kind of does that, you can then move your stop up to trail below that line. All right, so you can just kind of move your stop point from down here to here to here to here to here. Okay, now again, you have to be willing, there's one caveat to that. You have to be willing to say, well, price is up here, should I take my profits or not? Well, ask yourself a question, and you probably have not asked yourself this type of question. All right, is the structure in price, so let's just say it stopped temporarily right up here. Okay, has the price structure shifted? All right, enough where this ATR line is in jeopardy of shifting. Okay, is there enough negative energy? Well, it may stop and pause a little bit, right? Because there's usually, you can see a little bit of volume up there, so the buyers encountered, some resting limit orders to sell, but the momentum here never changed, did it? All right, those buyers were still very aggressive and they wanted to buy, those contracts. Okay, so again, unless that ATR line breaks, okay, now how do you know when it's going to break? Again, we'll go over that as well. All right, yeah, as the volume shelves, the ATR, every time the ATR price ratchets a new high, okay, so an uptrend, it kind of follows along, then it stalls a little sideways consolidation, a little ledge, okay, so it kind of gives us a little shelf. Then it makes a new high, new high, new high, and then the ATR begins to follow it. Again, that's the idea, all right, for the ATR line, is to follow it. So it's useful in 2 ways, all right, mainly. One, to primarily identify when there's enough energy to shift price. 2, all right, help us stay in a trade if the, again, this was probably a big short squeeze the other day, all right, last week. But think about this, right? The idea of staying in a trade for a long period of time, right, is one we all dream about, right? Yet we tend to have nightmares because we're not in them when moves like this occur, all right, and we're not positioned properly, or we're on the wrong side and we have to struggle to to cut our losses, whatever the case. Right, these are like the ones we have dreams about. Wow, if I only bought them here and I used a management method, right, to stay in the trade. Okay, well again, this is not only a management method, which is really what it was primarily designed for, years back, by Wells Wilder. All right, but it's actually an entry method. It's actually a structural identifier, okay, to either buy or sell. So let's just move along on the chart here a little bit. Okay, now you can see here, and what I want to show here is where it reshifted, right here. Okay, so what effectuated the shift? Okay, so as you can see, price was going up and up. The 5 bar, average high and average low, I kept nicely moving along. Price came down and there was enough energy this time, okay, on the pullback to pull the 5-bar average high down enough and effectuated a shift right here. All right, does everybody see that? Okay, so this tells us that this bullish, strong, big move that occurred on that particular day, for the time being, is over. All right, and the reason why it's over, because now all the bullish momentum has been really effectively bled out of it. All right, and then some selling came in, and now the selling becomes strong enough, all right, to change the ATR line. All right, so now what this does, number one, it tells us that this bullish move is over. Number two, does it automatically give us an opportunity to short? Not quite, but it does tell us now the risk of being long is beginning to increase. Does everybody follow me on that? All right, the risk of being long becomes greater now. All right, okay. Notice the shift is working in the CCI. Yeah, we'll discuss with the CCI as well along with this. All right. Yep. Okay. So when you get, and I'll kind of give you some guideline rules to follow here, towards the end. But one thing I want to show you here, okay, and again, we're kind of splitting sessions here, but it still makes it a pretty good important point here in terms of what I want to show. But notice here, once we got the ATR shift, okay, price, pulled back here, okay, and then, we had a couple, well, again, they're not on the chart here, but they're on the CCI indicator, so we had a couple discounts here. And I'll overlay the discounts in a moment. But there were a couple discounts here. And then price kind of came back up, all right, to that ATR line over here to the right. Notice what happens. There's really not enough energy, all right, here, in this up move in price to effectuate another bullish shift like we saw earlier, okay? So what happens is this becomes your dynamic resistance point. Okay, and you can see what happened here. All right, price pulled down and then popped back up, right up here to the ATR line. Well, this ATR line, guys, is a sell zone. Okay, you can short against the ATR line, you can short at the ATR line, you can short slightly above the ATR line, so long as it does not shift. Okay, but keep in mind, what's it going to take to shift the ATR line back to a bullish configuration? It's going to take at minimum the 5-bar average exponential low of price to move past that ATR line. Well, you can certainly see here this quick reaction, this move down and then back up. This ATR line was not in jeopardy, all right, of breaking. Okay, so this became a sell opportunity, a short the pop opportunity. Now it becomes, you can see here on the CCI, it's actually a premium. Okay, it's in premium territory. We got a shift in the ATR. All right, so now we don't really want to be. We can look for longs. Just one thing in mind. We can look if the pullback is deep enough. We can look for longs, but, all right, and there's a caveat here. If you're trading the long side below a bear ATR line, the probability of price moving a great distance is remote, okay? Because price has to build enough energy to reshift that line. Once that line shifts back to bullish, then price is realigned with the bullish configuration. But if price action is below a bearish ATR, okay, be cautious on any longs. Doesn't mean you can't take them for a scalp, but don't expect a big move out of it until that ATR shifts again to a more bullish configuration. You saw over here on the left-hand side where it went from a bear to a bull and we had an explosive rally. Okay, now it stops, the rally's over, now there's a bit of consolidation that goes on. Now let's just continue with the chart and see what happens. Look at what happens. Okay? Now in hindsight, you're looking back and saying, wow, those were golden opportunities somewhere in here to take a short, weren't they? All right? So now we have the ability to look at these ATR lines perhaps in a different way. Okay? They are tradable, actionable opportunities. Okay? Now many times they do correspond to a spike in the CCI, all right, either to the premium or to the discount, all right, and you can use that as an opportunity to say, hey, price spiked up to the ATR line, I want to sell that ATR line, and it's a premium. Okay, I want to sell that because I got two components of my trade methodology on my side, all right. Now, how you enter the trade is not for discussion today. I mean, you can either, you know, enter it at the line, you can use right side pivot rule, okay, as we you know, discuss. Again, that's going to be your choice, all right. It all depends how aggressive you want to be. Maybe you enter on one and then you use a buy or a sell stop to enter on the next one, okay. So, but what happens is when you get an ATR line shift, respect it, okay. Respect it, but not only respect it, look for a trade. Look for a trade opportunity, okay? If you get an opportunity, you know, like this one where it bounces, kind of retraces back to that line, all right, it becomes a great entry, great trade, all right? And again, I'll just scan back a little bit shortly and you'll see. But now look at this one. The ATR shifted as we saw. We had an opportunity to short them up there. Even if you didn't take that opportunity, okay, and price rotates down lower, and now we have bearish configuration. We have a bear stacker formation, okay. Now ask yourself, all right, since you've learned this, all right, today, what is it going to take to shift this ATR line, the bear ATR line, back up? What's it going to take? All right, it's going to take the 5-bar average low line here that you see. It's going to have to go like this. It's going to have to shift up. Okay? What is the likelihood in a condition like this that that's going to happen? You got a bear stacker formation, you got momentum now to the downside, all right, with fair value is decreasing. If we overlaid the fair value zone, okay, it's decreasing. So what's the likelihood of this moving back up? All right, slim to none and slim left down. So this becomes dynamic resistance, all right, to put on a trade. Now notice at this stage there's no signal in the bars, right? We're kind of the sidewards, you know, consolidation right in here underneath. Well, where do you put on a trade here? All right, anybody have any idea? Where would you put on a trade, or where could you put on a trade? All right, you could put on a trade anywhere in here. Okay, anywhere. Where would your stop be? Well, my stop's going to be somewhere above this ATR line. Okay, the confidence of, I mean, I wouldn't put it right tagging the line. I'd put it, you know, maybe a few ticks above it if you want to trail it. But the likelihood of you getting stopped out is very remote because of the momentum in price. All right, and then how could you, you know, another way of entering as well is on a break of the lows here. So that would be, you know, a break of this low right here, because you know what's going to happen when you break the low. What's going to happen to the ATR? It's going to shift lower. It's going to ratchet down. Okay, so where would your trailing stop be following your entry? Right? It could be right at this line, right up here. But now you know what's the likelihood of you getting stopped out, everyone? Slim to none and slim left down. Okay, because now the momentum is pushing down. Well, you're very unlikely you're going to get stopped out. Now, again, keep something in mind, guys. You can't have a 3 or a 4 tick stop. Okay? This is designed, right, to keep you, you know, get you in a trade with relatively remote risk, very small amount of risk, not no risk, but low risk, but keep you on the correct side. all right, until there's enough energy to shift it back. And when there is, then, you know, we'll either get stopped out, or we'll have already been taken out of the trade, you know, for a profit. Okay, but again, even if there is no premium signal here or anything, you know, and it's just kind of sideways, think about it. What's the momentum in the market? We always want to be on the correct side of the action, right? So we want to be on the sell side here. And where would our stop be? Up there. Now I have the confidence that the likelihood of that getting shifting is remote, because I know what the filter is now. All right. So let's just move on and see what happens here. Again, even, you know, down here, all right. Again, price kind of ledges out a little bit, consolidates. Again, where can you take a trade, right? You know, anywhere. A break of the low here would actually work well. You know. All right. Where do you put your stop? It's going to be trailing above the ATR line. Right? Is everybody kind of getting a picture of how to use this? All right. Okay, and of course, you know, we all see what actually happened, and then when was the final shift? Right here. Okay, what effectuated the shift? All right, the 5-bar exponential low came up, boom. Now at this point, this sequence, all right, of events, all right, this big move down. Now, again, we've had recently some very, very big moves, okay? But this is designed to get you in. Now, if you really look at this action here, everyone, let me just clean off the chart here for a moment. All right, I want to point something out. Does anybody see any premiums here as we've defined them? All right, price at or above the 89, 34 below, and/or the CCI being above plus 100. Does anybody see any premiums here, aside from that very first one in the overnight period? All right, but in the day session here, all right, as it's unfolding, we don't really see any premiums here, do we? All right. So if you're a you know, if your trade plan calls for, you know, I want to buy and sell premiums, well, you know, you're basically shit out of luck if that's the case, because you're sitting there saying, well, I don't have a premium, so I can't put on a trade. Well, what I want to expose everybody to is a concept, okay? Rather than, you know, yes, use your premium and discounts, but I really want you to think about what is the side of the trade that we need to be on, long or short. What side of the ATR? Is it a strong trending condition, right? When you get these periods where price comes down and then stops and kind of ledges a little bit like this, all right? Is there an opportunity there to take a trade? All right, it's great on a trend day, Steve. Absolutely fantastic on trend days, and it works equally well on a range day. But it's a little bit, you know, a little bit more choppier. We got to be a little bit, you know, a little bit more careful on a range day. But again, it's going to work to help keep us on the correct side. All right, regardless of what day type we have unfolding. All right. Again, guys, you know what I want to get across. There's no math here. You know, there's no calculus, there's no reading number bars, there's no trying to figure all this stuff out. Simply, we want to stay in alignment, and you know I speak a lot about that on the daily trade strategy. We simply want to be in alignment, okay, with the dominant force. So whatever that is, as it's unfolding, all right. Ideally, we would like to get entries following a shift, all right, a point break shift. On a pullback, okay, as it's developing a new potential move. Again, we don't know how far any move is gonna take us. We initially go for our 2-point rotations, but you know, as we've seen recently, you know, the market moves, you know, has been moving greater than 2 points. Okay, now as we move along, all right, look what happens. Here's the shift, right? Look what happens. There's the shift. That's where it occurred. All right. Price has enough energy to move up and break the ATR line. All right. So ending that sequence down. And then price pulls back. Guess where it pulls back to? The ATR line. All right. Is that an opportunity to enter a trade on the long side? You betcha, as Sarah Palin would say. You betcha. All right. That is first pullback following a new swing high. All right. Following a point break. All right. This is the first pullback. So we want to get in. And now, question is always, well, where's the entry bar? There is no entry bar. Okay? No entry bar. What you can, though, do, all right, let me clean off the chart. I want to make it perfectly clear for everybody. All right, so we have a true understanding of what we're looking at. You know, it's interesting that you say that. It is very similar to the old AJ. Yes, it is, Nick. All right? Absolutely. I mean, it's not rocket science here, everybody, right? This is simply the first pullback following a shift. Okay, and it's and for those of you that have been with me for some time, a lot of my emails that I used to send out states from WD Gann that the safest place to enter a new trade is at the end of a correction to a new swing. So what's the new swing? Up. What's the first correction? Okay, the first pullback. All right, so we call these stackers bull and bear stackers because, very simply, all right, it is, in casino language, it's, a lot of people seem to, say, hey, they're stacking the deck against me. Well, boy, if they're stacking the deck against you, it's hard to beat the dealer, right? Well, we want to be the dealer here. So this is a way of stacking the deck. Structurally, so the ATR line gives us a point break structure. Price, pattern, momentum. Okay? The pullback now offers us an opportunity to buy at the line on a pullback, or you can use right side pivot rule. So I'm kind of entering the components of what we do, right? So there's our pivot zone. Now it's not a good clean 3 or 4 bar pivot. It's a kind of a complex pivot in here, but all right, using the right side pivot rule, you would be buying them coming out of that little pivot consolidation, right? Everybody agree? So where would you be entering on the right side pivot? All right, you'd be entering here. Okay? You could have entered on the line there if you wanted, all right? So now knowing that when you have an ATR shift, this is a pretty good low risk trade, all right? And again, guys, worst case, if this doesn't play out, what are you going to lose? 6 ticks maybe? 2 points at maximum? If it doesn't work out, buying it right on the line? I want to buy it on the line, all right? I want to buy it right on the line. And these all have values, all right? All right. Yeah, you can buy one on the line. You can add it using the right side pivot rule. Okay. And then, of course, once you establish your position, your stop will be below the pivot low here. All right. And then you let the market kind of unfold. You need to let the market unfold. All right. Everybody is like, you don't want to play the game of hot potato. As soon as you get into a position, you want out of it. Okay. You get into a position, you can get into it methodically. Don't worry about what's trading here, by the way. Okay? Oh, wait a minute. 3,000 contracts traded at that price. Oh my God, I better not buy them. It doesn't matter what the contract size is. Whether you're trading 1 or 2 contracts and somebody's trading, 1,000 contracts, who cares? Point is, structurally, that's where I want to buy them. Okay? And yes, in a case like this, we can buy them. Again, I don't typically advocate buying downticks, but when the market shifts here bullish, I want to buy a pullback. How I buy a pullback, or how you buy a pullback, is going to be predicated on what you have outlined in your trade plan. So although I can't tell you what to put in your trade plan, I can certainly suggest to you, and that's what I'm trying to do here. You want to, one way to do it is, buy one contract, on the line. use the right side pivot rule. Standard entry method for us. Okay, so that gives you, let's just say, 2 contracts with an average price in here. All right, you're not averaging down, you're averaging into a good position. And then you have a reasonable stop. All right, and then simply at that point, everyone, you let the market unfold. Okay, so here you go, market unfolds. Let's see what happens here. Again, I don't even know what happened in this one. There's our entry. All right, oh, a secondary entry, if you will, all right, could be, if you missed, that one there, look at the stacker conditions, how it shifted here from cyan to green. Okay, a secondary entry could be in the context of that zone right there. Now, most people won't do that because they say, well, I could have bought them down there, I'm paying too high. But are you paying too high? All right. Now, again, we have the benefit of seeing what happened. We don't know what's going to happen when this is the right edge of the chart, do we? What I want you to do, though, on your own is go back and take a look at these things individually. All right, what I'm describing here, I can go back months upon months and years upon years, and it'll be very, very similar to exactly what we're talking about here. Okay, so again, part of all our trade setups and everything is repeatability. All right, identifying a trade, the repeatability factor. All right, all these things are repeatable in very similar format. So if you bought them here, where would your stop be? Well, initially, perhaps down, on the low here on this ATR line, but you're only talking 62, maybe 60, so 2-point, maximum 3-point. But think about it. Do you think you're going to get stopped out 3 points with a configuration like this? Truly think about it. Slim to none and slim left town. All right, where's the momentum? All right, price, pattern, and now momentum. All right, so you're buying momentum here. When you buy momentum, all right, you're expecting and anticipating the momentum to continue in the direction that you bought them in or sold them in. That's what you're doing. If you're buying structure, all right, here is buying structure. Pull back to the ATR line. That is buying structure. There is no momentum here. Okay? It's price, pattern, and then momentum. All right? If you're buying momentum or selling momentum to get onto a move, expect that move is going to increase, directionally. All right? And you have to be aggressive. To buy a momentum move, you got to use a market order. To buy a pullback structure move, right, you can use a limit order. You can use a buy or a sell stop. But if you're going to buy momentum or sell momentum when it's moving, you got to market order, get on board. The question has always been, and the fear has always been, well, where do I put my stop? Well, if you have a bull stacker, as this has shown here, all right, and by the way, for those of you that have not reviewed the bull stacker, bear stacker workshop, all right, I highly recommend that you do that. Okay. Yeah, in a case like this, all right, Steve, when you have a bull shift going on, the premium signals that may occur here, okay, are more likely going to fail. And I'm going to give you kind of a base guideline, all right, to use when it comes to the premium discounts. All right. I just want to just continue on just a little bit more. Then I want to add some indicators to the chart here. So as this is going, right, momentum continues to push higher, price gets a pullback. Okay. Now, is this too late to buy up here? All right. It might be. We don't know. Here's the thing. If the ATR line, if it pulls back to the ATR line, where do we want to buy them? All right, I want to buy them at the ATR line. Because if I buy them at the ATR line and this breaks, okay, if this was the shift point, right, then you know what? I'm going to have a loss, small loss. But guess what, guys? I would rather have a small loss following a set of guidelines, right, than buying them on the way down and selling them on the way up, and I have no way of knowing how far it's going to go against me. Okay, this I already know I have a very limited amount of risk. All right, besides I got good momentum on my side. All right. Again, the other way of playing this, all right, practically, is on a pullback to the ATR line. Use your OTA loop, observation, orientation, decision, action. Ask yourself, is it holding? Is it holding? Is it holding? Where would I get in if it continues to hold? Where would you get in if it continues to hold, everyone? You can use right side pivot rule. All right. Again, I'm not placing prices. I'm just saying I'm putting structure. You could pay right side pivot rule. Where would your stop go? Underneath, that pivot line. All right. Pulls back here again. Shallow, relatively shallow pullback. You see that the structure is still very much, bullish. Okay. Where do you want to get on? Again, I'm not going to highlight a specific price, but again, how about somewhere, within this area right here? After it stops going, down or pulling back and then starts moving back up. That's where you want to get on. That's where your risk is lower. Believe it or not, if you're buying, the risk is actually lower, right, when you buy on upticks than downticks. When you buy on downticks, how do you know how far that's going to go? Well, we have a certain measurement. Oh, by the way, here on this area right in here, look what we got. We got a discount, didn't we? So that would be a discount in an uptrend with an ATR, bullish ATR line. Mandatory trade. All right, it's mandatory trade. You want to take that discount with the ATR line underneath you. You want to take a premium with the ATR line above you. Okay, let me just and then now, and again we'll end with this. Well, we'll end this segment with this particular shift. So there's your discount. All right, blast off. Everybody, has a winner on the discount, and then now price comes back down, and look what happens. There's enough energy now to change the dynamics again. There it is. There's your shift. What happens to this move now? What does that mean for us? This up move is over. It's done. The sequence of this up move is complete. Notice what happens. All right, get the ATR shift. The ATR line now becomes dynamic resistance. Okay, price pops up a little bit. Oh, little last bullish gasp. Bullish. Bull gasp. That's what I'm trying to get. I'm sorry. Gasp. All right, and there's no more energy. That is a fade. You talk about a fade trade. All right. This is actually the first pullback. Does everybody see the first pullback? Okay, good. I want you to be able to identify the first pullback. So, price pull down, enough energy to break the ATR line, and then a bounce back up. Does not have to touch the ATR line, mind you. All right. Sometimes it will, sometimes it won't. That's the first pullback. All right. Forget about that they're green bars for the time being, because that's not really going to matter much. Structurally, it's a pullback. There's no more energy. All right. Guess what's going to happen? I mean, you see what happens, but what's the normal sequence? Price is going to come back down. Where do we want to enter the trade? All right. So we want to get a pivot. All right. And we want to enter the trade on the right side pivot rule, right? So, somewhere in here. Are you going to be that far off this retracement high? No, you'll probably be maximum of 2 points or so risk. Where would you put your stop? Again, you see where it is, and then as you're coming down, you see that the momentum now has shifted to the downside, and you know that ATR is coming down. So now you almost, in one sense, you almost don't have a whole lot of risk, if any. But again, I can't state that you won't have any risk, but you'll have very minimal risk. So there's the first pullback. On the opposite side, we saw it on the bullish side. Here's this one on the bear side shift. Okay, think about getting that first pullback, guys, right? It is by far the safest trade out there, bar none. I have not encountered a better trade, that has greater possibility and probability for success, than the first pullback. All right. Let me just pause the projection here, and I want to put on some of our indicators, our premium and discounts. So just give me just a moment. Okay, so before we get back to the charts, what I want to do is we went over the practical usage of making some trading decisions just using the ATR line in and of itself. So we saw that a pullback to the ATR line can offer us an opportunity, all right, to enter, all right, at or around that ATR line itself. Okay. Now what we're going to do here in the next sequence, we're right at an hour, so I'm going to take maybe about another 10 minutes and we'll end there. But what I wanted to do, and this is essentially putting it all together, is blending the ATR structure with our core trade setups. Okay. So let's go to the charts. And what I've done is I've moved the chart over a little bit, all right, so I can identify some of our key setups here. All right. Now, the premium and discounts. So if you want to write down some of these rules, I didn't get a chance to put it in the PowerPoint, but if you want to write down just some of these rules or guidelines regarding premium and discounts as they relate to the ATR line. Okay. All right. So first off, our premium and discounts, all right, are high probability when they are in alignment, meaning they are on the same side, okay, as the ATR stop line. Their highest probability, and simply what that means is they have the ability to give us a greater profit. Okay, so if the discount triggers and the ATR line, let's just use the bullish scenario here. So if we have a bull ATR line and we have a discount signal, okay, that's in alignment with each other, all right, take the trade. All right, get in, if it's a valid trigger, take the trade. All right, don't hesitate, take that trade. Though if the discount, all right, develops, gives us an alert with an ATR line that is above us or above the discount, right, the bearish ATR line. So a discount with a bear ATR line, all right, make sure you have a good valid trigger, because the probability of that discount fully playing out, okay, for perhaps what you're trying to get 2 or 3 points out of it, the probabilities are decreased. So again, discount in alignment with the ATR line, meaning underneath it, take the trades. If you have a discount with an ATR line above it, all right, caution is warranted. Does not mean you cannot take the discount, though I want to make sure that caution is warranted. Okay? Now, on the flip side, if you have a bear ATR line and you have a premium, okay, you want to be looking to take that trade, especially if the premium is developing in the early part of the move. All right, could be the first pullback, could be the next pullback within the developing trending directional move. Take it. There are times though, and again, everything has a caveat, right? There are times when there is a premium or a discount that develops near the low end of the move that may not trigger. So as you can see here, you have premiums right here. Okay, valid premiums. But notice that the channel here on the average is moving up, and also, when we use our lead line, all right, our 13 EMA lead line, that will more likely be pointing up. Well, first off, the lows of these bars never got taken out. right? So although these are valid premium alerts, they never triggered. Okay, so if this was to trigger, so if price, stopped, and pivoted back down, okay, we want to be taking that premium. But you got to make sure we have a valid trigger. Like as with all our trade setups, an alert is an alert. We want to make sure we have a trigger in it. Okay. Now look at this discount. All right, and this is kind of a real good example. Now this doesn't always play out this way, but we got the ATR shift, and we got a bull stacker. Right, so the trender bars turn color from red, dark red, cyan to bright green. So that tells us we have a bull stacker. And so we have enough energy that pushes up, and we get a pullback. Notice we have a discount here. See this discount? Right? That is a mandatory long trade. Okay? Everybody in the room, mandatory long. Right? There's your quick reference price, 64.25. You can get it in at 64.25, or you can get it even if you paid, a bit higher. Okay? That is a mandatory trade. Think about that. You got a bullish shift, right? A stacker. Oh, and you happen to have a discount. Now, a stacker does not always happen to have will have a discount component in it, all right? But sometimes it does, and that is a mandatory trade. Okay, does everybody understand that? Now let's just look at these. Okay, now the end of this move, price pulls back. We have a discount, right, alert, right? But what happens? All right. Well, we got a discount alert. By the time it gives us a trigger, all right, what happens? We got an ATR shift. Uh-oh. I'm not so sure if I want to take that discount now. All right. And then notice these discounts, right, that all fire right in here, okay? Notice they never really triggered. So although they're discounts, you're saying, wait a minute, I have discounts here, but I have an ATR line above me. Look what happens. Are those valid discounts? They are valid discounts, but they don't trigger. All right? Now this one was coming into 4 o'clock, so we wouldn't have taken this last one. All right. Does everybody see how the rules or the guideline here for premium and discounts? Okay. So if you have a discount with an ATR line underneath you, bullish, right, you want to be taking those. All right. Unless it shifts like it did here, then you want to exercise some caution. If you have discounts that are below an ATR, a bear ATR line, exercise caution. You are still able to take it. You still have a green light from me and from the method to take them, but make sure you have a good valid trigger, all right? But don't expect that it will go up, like we did, when it's in alignment with the ATR line. Okay, this helps. These are just guidelines. Okay, now look. Here we got the ATR shift. Now we have a bear stacker. Okay, pushing down. We had that little ledge we spoke about, little sideways consolidation. Now we added some premiums. Now these are turbo premiums. All right, this is the setting here on the turbo premiums are 16 or 17 rather than the normal 34. I will make sure that everybody has a template for these. Okay. And again, one of the reasons why I went to do it, what we're going to call a turbo CCI or turbo premium and discount, is on these strong trends up and strong trend down, we're having a difficult time getting on board. Okay, so here's a case where you have premiums, right? This bar, that bar, that bar, that bar, and again, as we discussed this shortly time ago, without these premiums showing, what did I say in terms of what price can you get in at? Well, you can get on here, you can get on here, you can get on here, get on here, get on here, or you can get on here on the break. All right. Well, you have a bunch of premium signals. Do you take those premium signals? Which bar do you take, and so forth? Well, you got a few of them there, so evaluate them. But think about this, all right? Your OTA loop. Where is the direction in price? Where is the momentum in price? Right? I have an ATR line that's above me. I want to take premiums with an ATR line above me. I'm in alignment with the structure. Okay? Knowing the filter now, what it would take to shift that ATR line back up, well, that ATR line is not in any jeopardy of being shifted back up. And if we were to look on a bigger, picture, there may be bigger downside targets that we don't currently see here that are available that we're shooting for. Maybe we're shooting for 1962 or 60s or 58s from this point, another 5 or 10 handles down, and you know what? Boy, I want to take that premium. I am in alignment, price is in alignment, all right? And those premiums are in alignment. You want to take those premiums, all right? Or prepare to take them. How about this one? Okay, price moves down, pulls back up. Guess what? Another premium. It's in alignment, correct? I want to take that. How do you take it? Well, again, you can use the reference price, 64. You can sell them there. You can sell them on the break of that low. All valid against that premium. You don't have to take the very next bar. All right, but you want to be in on that trade. All right, and then again, your stop goes somewhere above that ATR line. But understanding the filter, all right, hopefully will start giving us more confidence that to say, I want to take that premium. There's no way that ATR line's breaking anytime soon. All right, now at some point though, guess what? All right, you reach a target. Look at this one, 57s, 58s. You reach a target zone. Okay, now we've all spoke about this live. When we get into target zones, premium or discounts, right? Careful. This is where we're going to start, exercising some caution, all right, on premium or discounts into the target zones, because then there's a likelihood of price shifting again. So now look at these premiums, all valid premiums, correct? All right, turbo premiums as well as regular in direction of trend premiums, all valid premiums. But look, all right, price is now getting back above that ATR line, and that ATR line is probably just about ready to break. Did any of these? My question is, did any of these premiums, the low bars, did any of them ever trigger? Yes or no? No, right? Okay, none of them triggered. Okay, so if they haven't triggered, remember, so if you're using right side pivot rule, so this is the beauty of the right side pivot rule. If you're using right side pivot rule and they never really fully develop, okay, then really there is no pivot. So how can you sell the left side of a pivot? You can't, because the pivot's not developed, right? You can only buy and sell the right side of a pivot. So now you're waiting and you're watching, you say, well, possibly that could develop into a pivot and maybe there's potentially more downside, On the other hand, if they don't trigger and all of a sudden the market, there's enough energy in price now that shifts the ATR, guess what? All the premiums are off the table. No trigger, no trade. If it shifts, we don't want to be taking that trade. Okay? Now, one last point. All right, one last point coming into the end here. With these premium and discounts, a failed or an unexecuted premium or discount. Let me repeat that. Either a triggered or a non-executed premium or discount, all right, that gets stopped out. So if you actually take a premium, and you get stopped out on it with a ATR shift, okay, there is a high probability if you got stopped out before the ATR shift that there will be an ATR shift, okay, and these will usually occur at the end of a move, so you need to truly understand where the big picture targets are. But as the development of a new shift or a new trending condition unfolds, if you either get stopped out or you have in this example, a premium that did not trigger, the likelihood, probabilities that is very high that you will be getting an ATR shift and which will develop into the next sequence bull stacker or bear stacker. Okay? So don't look at these as, oh, these didn't work, or shit, I sold one and I got stopped out. Well, if you got stopped out, fine. Guess what? It's a small price to pay, okay, to say, okay, I got stopped out. Well, that didn't work. Hey, I got an ATR shift. Okay, what's my next trade? My next trade is going to be a long pullback to that ATR line. All right, if I get it, if we get the opportunity. All right, I want to buy that ATR line. If there's a pivot then there that develops, okay, I want to go right side pivot rule. I want to get in there. So I shorted in there, I got stopped out. Okay, I'm going to go long now. But go long with the proper structure, enter it in the proper way, all right, and then get on board the next sequence, all right. So there's multiple sequences that occur throughout the session. We want to be in alignment with the next sequence. Now, if you get on here and it stalls and it comes back down and stops you out, or it doesn't go anywhere, we can scratch on the trade and wait for better development. There are times that we have seen, and we don't have time to go over this today, but there are times when we're range bound, prices will move up, it'll break the ATR, it'll move down, it'll break the ATR, it'll move up, it'll break the ATR. Well, when that happens more than twice, in other words, if it breaks the ATR bear line and it comes back down and breaks the ATR bull line, you're more likely in a range or a sideways kind of larger consolidation point. All right? Any questions on this? I hit every bit of the topic that I wanted to, discussing the ATR, the construction, the filter, okay, and then bringing it together by using it as a decision maker in and of itself. Also bringing in the premium and discounts and how we can use those with greater confidence, okay, and work with these, okay. There's one thing that I really want to stress to everybody, and I can't stress it enough, is that you really need to go back, on your charts, okay, and look at this stuff. Now, this was a period here, you can clearly see that there was a lot of sideways, volatility and chop, and this was a very difficult, challenging day to trade, okay. All right, but at the end of the day, though, you don't, like here. Look at. I just want to quickly. And I'm probably keeping you guys a little bit longer, but I want to just point some of these things out. Okay. Now again, I want to point out what we discussed. Okay. So price over here on the left-hand side breaks the ATR, pops back up. Where can you look to sell them? At the ATR line. Okay. Can you get a trade out of it? Can you scalp a couple points out of it? All right, probably. If it develops into something bigger to the directionally, you have a trade, you're on board. All right, what happens here? That price shifts back up and it breaks it again, and now it becomes a bullish ATR. Well, guess what? Look to buy them on any pullback at or near the ATR line. That's a good opportunity to get in, because what we don't know is, we don't know how far this next move up or down is going to carry, right? So we want to try to get them at or around that ATR, right? Notice again here, breaks down. This is a little bit more volatile on this move. Back up, all right? Now here's a premium, but the premium didn't trigger. Okay, you can clearly see that the premium in this one didn't trigger. So if you were saying, all right, you know, I'm looking to take that short, but I'm watching to see that premium plays out. This one doesn't play out; it goes up. So maybe you pass on it, or let's just say you did take the trade right at the line. Okay, so this one might have been a small stop out. Maybe you even got a chance to scratch. All right, but guess what? When the price comes back down again and holds the ATR line, what is it that you want to do? You want to look to start, you know, looking to take the trade around that ATR line. Okay, or at least start, you know, thinking about, well, is there a pivot? Is there a right side pivot rule that I can implement the trade idea? All right. Again, these are not automatic trades. I'm not trying to say this is an automated system, but rather a decision matrix using your OODA loop, but using the tools that we have effectively. All right. And then here again, a little bit. This is still a little bit sideways action. Here is another shift during a sideways rotation. All right, where price came down, popped back up. Where is your opportunity? All right, to take a short trade. All right, at or around that line. If you happen to have taken this discount, for instance, right? Because here, take a look down below on the ATR, you know, on the CCI. Hey, you got a discount situation there, right? Let's just say you bought this discount on this deep pullback, okay, and then price bounced up a little bit. Well, you want to use that ATR line as your exit point. All right. Hey, if you bought them here around 64 and it popped up to 66, there's your 2-point rotation. You have an ATR line there. I'm not so sure it's going to break through that. I want to take my profit, especially if you're in kind of a sideways, you know, all right, you know, trading, you know, market like this. All right. So buy the drops, sell the pops in a sideways range. When you get an ATR shift, look into the ATR lines, all right, as opportunities. All right. So Bruce today had asked, can we use these as individual decision points, all right, to take trades, you know, individually, right? And I said, yes, you can. And again, this is how I'm demonstrating it, you know, for everybody tonight. So go back, all right, scale out, look at some trades. Okay, you can certainly see, you know, and again, one thing I would recommend is, you know, to be proactive in some of the things. Create a vertical line, all right, on your charts, all right, you know, use them, and then every time you get a point break, okay, like you see here, mark it. You may even want to put some text, okay, in there. So you can see this premium right here, okay. You get a point break there, you get a bounce, you get an opportunity to sell one there, you get another opportunity to sell a premium there. These are the trades, everyone, that, you know, are not, let's just say they're non-standard trades, but they're going to become standard trade setups for us, all right? And the ability to get on board an early move, you know, look at this monster move that occurred here. Okay, now this was during the day session, so we had plenty of opportunity to get on board this. Wouldn't it have been nice? Now let me just quickly zoom in, and I promise I will end here. All right, but there's just so many examples of these things, you know, that I get excited about it. But here is the shift. Clean, clear shift. We have a bull stacker, right? Price then enough energy, and then price pulls back. Look at that discount at 1977. All right. Do we know the price is gonna rocket and roll all the way up? You know, there? Of course not. All right. But we wanted. That's a mandatory trade for us. Just think about it. Win, lose, or draw. Right? If you were trading, you know, if you were trading for other people, you said, well, you know, that's what I look for. And if I lose on that, well, okay, I lost on that. All right, but that's what I look for. That's what, because I can show examples upon examples of trade opportunities that work, very, very well. Okay, and then this one, remember we saw a whole cluster of discounts, but the cluster of discounts very similar to this was it was underneath an ATR line that was above us. Okay, and what was the general guideline for that? That if discounts, all right, develop and trigger, but the ATR line is above us, all right, we want to be cautious on those, right? Well, here is a cluster of discounts, but the ATR line is below us, which is a bullish formation, all right? So all what we needed to do, here was be selective in terms of our entry, all right? So let's just take a quick look at this, and I'm going to snap a line approximately where all the discount bar high references were, all right there at 84s. Okay, so as price came down here into the ATR line, what could you have done? You could have bought at or around the ATR line, all right? That's one way, all right, because there was several discounts there, right? But they didn't really trigger because they didn't really get above, the bar reference bars. But how about this one? All right, as it finally ran its course, how about this area right here? Everybody see that? Price finally made a low and it came back up and a little minor pullback there. All right, would everybody agree that this is the right side pivot rule in this area right here? Rob, you coined the phrase. All right, that's the right side pivot rule. All right, just because you didn't take a trade on the exact next bar of the discount alert bar doesn't mean anything. You want to make sure that the structure is sound, and in this case the structure was sound. All right, again, it came very close to shifting there, but it didn't, and then it repaired itself, and then you say, okay, now the momentum's building again, I want to buy them here. Okay, so if you think about it, you're still buying them roughly at the reference price of all those discounts, but the main difference is you're buying them now with new fresh buying that's coming back into the market, not on the downticks. If you buy them on the downticks, okay, you run a little added risk of maybe getting stopped out depending on how tight your stop is. But if you allow the discounts to form, trigger, and give you a good pivot or pivot zone, and then buying them on the right-hand side, don't think that you're paying too high, because frankly you're not. All right, you're buying them when the structure allows you, right, to have a momentum, followed by a momentum move, so then you can get paid on that. All right, remember, you get paid with momentum. We look for price structure, right? Price, pattern, and this is a pattern. This whole setup is a pattern. Price level, right? Retracement or a zone, pattern, and then the ultimate is momentum, and that's where we get paid. But we want to buy or enter a trade or sell it, to enter a trade with the proper structure. All right, we don't want to have to be chasing after something. All right, we want to understand where to get in. Let's position ourselves, again, forget about trying to buy or sell the high or the low. Focus on trying to get in on the proper structure. Now, this structure works great on crude oil, soybeans, gold, you name it, right? Monty's been having some very good trades using right side pivot rule, all right? And I appreciate his posts in the room for everyone when he concludes his trades. But again, this is the type of structure that we're looking for. Very simple. It's not rocket science, and we don't have to overthink these things. All right. I really kept everybody a long time here. It's an hour and a half, but I really thought that this is important to make sure that we get a good understanding of these, a practical application. All right, of using the ATR combined with the discounts and premiums and the stackers. Okay, so I'll have this video rendered as soon as possible, And there's also a video in the archive section on the on the stackers that's available for all our members. All right. So we will see everybody in the trading room, and have a great rest of your day. And thanks for attending this workshop. I hope it's been informative, and we'll put this into practical use day to day in the trading room. Okay. Thanks very much, everybody, and I will conclude the video right now.